Now, because most funds have a time horizon of about 10 years, the valuation method used and the distribution of profits between the GP and the LP can become complicated. Let's say we've got a 100 million fund, for example. It's in the third year of its existence and it receives 60 million after selling one of its companies in which it invested 10 million. Assuming the carry of the GP was 20%, then the GP would keep 20% of the profits and give 80% to the LPs. But it's not that simple. If, for example, all the other investments in the fund have failed, then the fund has received 100 million in capital and has only got 60 million it will ever return. So the 60 million has to go back to the LPs as there are no profits. But what if the remaining companies in the portfolio have a valuation of 140 million? In this case, the fund will have 60 million in cash and the remaining investments are valued at 140 million, giving the fund a total value of 200 million from a 100 million capital injection from the LPs. In this case, the GP would be entitled to a share of the carry on the investment sold. That will be calculated as 20% of the 60 million received, less the original investment of 10 million, and the GP would get 10 million. But what if at the end of the fund's 10-year life, the other investments, which had been valued at 140 million, are worth zero? In effect, this means that the fund generated 60 million in total returns despite a capital injection of 100 million from the LPs. Unfortunately, in this case, the GP will have over-distributed profits to itself. This will make it subject to a clawback where the 10 million received on the first investment in year 3 of the fund would need to be repaid to the LPs. Now, to avoid this problem, some limited partnership agreements have clauses that prevent the GP from distributing profits until they've returned the full 100 million of capital committed by the LPs. Also remember that management fees have the capacity to significantly erode the capital base of the fund. In a fund of 100 million, where management fees are set at 2% per annum, the fees would consume 20 million of the fund's capital base over a 10-year period. Now, LPs don't like this because it will limit the number and the size of investments the GP can make. So to find a balance between the GPs who want to maintain their management fee and the LPs who want as much of the capital funneled towards investments as possible, most LPAs allow the GP to reinvest or recycle interim profits into other companies. So if we look at our original example where the GP makes 60 million from the sale of a company, if the GP wanted to fully cover the 20 million in management fees that would be charged over the life of the fund, he could hold back 20 million of these proceeds and distribute 40 million. Based on the fact that 10 million of the 40 million would be a return of capital to the LPs, then the remaining 30 million would be split, with 20% going to the GP and 80% going to the LPs. In reality, in order to align the interests of the GP and the LP, the GPs also contribute to the fund. Now, the amount the GP contributes is usually around 1% of the overall fund, but many times it can be as high as 2 to 5% of the capital. Now, our final consideration regarding valuations and distribution of profits relates to LPs' opportunity cost of money. LPs will justifiably argue that they're committing their capital to a VC fund and they are foregoing far less risky returns in other asset classes. So they want greater assurance that investing in a VC fund will pay them a premium relative to other asset classes. To account for this, LPAs introduced the concept of a hurdle rate to the profit calculations. A hurdle rate says that unless the fund generates a return in excess of the hurdle rate, the GP is not entitled to take a carried interest on the profits. This hurdle rate is negotiated and established upfront in the LPA. If the fund exceeds the hurdle rate, then the GP can start collecting his carried interest as if the hurdle rate didn't exist. So if the GP clears the hurdle rate, they get their full carry. If they fail to reach the hurdle rate, they get nothing. Sometimes the LPA will utilize something slightly different called a preferred return. In this case, the GP only participates in the profits after the return is met. So in a 10-year fund of 100 million with a preferred return of 8%, the expectation would be that the fund would be worth in excess of 216 million at its end. If the fund only generated total returns of 200 million, the GP would enjoy no share in the profits.